Welcome back to the Disciplined Troublemakers podcast. I'm your host, Scott Shagory. Here on DT, we talk about scaling great tech companies and helping CEOs do this with greater ease and flow. Today, we'll be talking with Anthony Nitsos. Anthony is the founder and CEO of SaaS Gurus, a firm helping young SaaS companies turn their finance and accounting technology pile into a well-defined ecosystem that supports scale. As Anthony likes to say, he and his team open doors to understanding. Prior to starting SaaS Gurus, Anthony was a director of finance at Lamasoft, a private equity-backed company, and previous to that, a director of finance and accounting with Duo Security, which was purchased in 2018 by Cisco for $2.35 billion. Anthony's education includes a BS in biomedical sciences from UMichigan. Early in his career, he was planning on being a doctor, and has 3 master's degrees, one focused on business, accounting, and finance, each respectively. Finally, Anthony, who lives in Michigan, is an amateur classical guitarist in his spare time. Anthony, thank you for carving out time today to talk with us, and welcome to the Disciplined Troublemakers podcast.
Thank you. I'm curious what a disciplined troublemaker is. I'm sure you can explain that to me, and how you think I qualify for this moniker.
Oh, you certainly qualify without question. Yeah, it's just, in short, it's basically
create any
people who
trouble. Me.
That's right. You're a SaaS founder, so by definition, you've created trouble. So, yeah, it's really about folks who want to make put a dent in the universe, who genuinely have a purpose and want to do something a little bit differently or think a little bit outside the box, and are very consistent and, kind of almost evangelical about it a bit, is how I think about, disciplined troublemakers within the technology space generally, and then SaaS in particular. Yeah. So let's go ahead and kick a question off here, which is that you went ahead and founded SaaS Gurus in 2020. And I'm wondering what has changed about how CEOs think about their financials and their performance metrics since you founded SaaS Gurus in 2020. Has there been any type of shift, or has it remained pretty much the same in terms of the core challenge around what they perceive to be most problematic for them, and then subsequently reaching out to you and your team for help?
So I think there's kind of 2 sides. Great question. 2 sides to the answer on that one. One is kind of more strategic, and the other one's more, call it operational, tactical.
Mm-hmm. Yeah.
I think on the strategic side of things, what's changed is the heyday of 16x valuation multiples of your ARR are done, at least for the foreseeable future, right? Yeah. There was a froth, there was a bubble, go back to the .com days, right? We go through these cycles of tech bubbles. This was the latest, okay? Yeah. And it burst, and those multiples are down around 5 or 6. They're probably low now, and there'll be a drift back up, but I don't see it. So that from a valuation perspective and a dilution when you're bringing in outside money perspective, and how much money is out there to be invested and what kind of conditions they're putting on it, that's kind of what I consider the finance impact. On a higher level. It's just harder to raise money, and you're not going to get as great a valuation as you did, and live with it. Frankly, that's a big shift. On the operations side, it is all about, you want to talk about evangelical. I'm an evangelical when it comes to, if you're a tech startup and you're VC backed, I don't care what anybody else says your KPIs should be, and whether you should be looking at CAC and gross margin. I would say you should focus on 2 metrics above all others, obsessively: your cash runway and your sales growth, right? Because pursuant to the finance impact, you now have a lot less cash to work with, period. The days of being able to go back out and say, hey, I reached my first $1 million of ARR and I'm ready for my A round. No, it's 3 to 5 now, and you better have reached it in a pretty, quick fashion, or you're not going to get much attention. So that means the cash that you have right now has to last longer. If you're a bootstrapper, it's different. Okay. But if we're talking, the venture backed, the VC, PE, angel, that kind of a company, then the major shift there is on cash as a, you need to forecast it, know it, be very intimate with it, don't ignore it.
Mhm.
And you need to focus on your go-to-market and making sure that you are getting as much new business in the door as you can.
Yeah. No, and that makes perfect sense. It is true that we're all familiar with or still remember 2021 when things were very frothy and exciting, and it was. It was easy to in theory, quote unquote, in air quotes, easy to raise money, at least for those who had received some. But a lot has changed. That's for sure. Maybe outside of AI, I work in the cybersecurity space, managed service providers, et cetera. And I've also seen a softening on the strategic side around what the valuations are, and then wondered about kind of the impact that it would have on the operations side, and what you shared makes a great deal of success. In terms of the differences, I know you and your team mostly focus on venture-backed firms, seed round, A round, B rounds in terms of that sort of work there in that space. But I'm curious because I work with a number of, I'll call them bootstrap founders, accidental entrepreneurs, et cetera, in the tech space. What differences in thinking do you see in CEOs who are focused on growth and exit, or even maybe starting at the exit and then focusing on growth with the end in mind already from the beginning, versus growth and maybe longevity?
I'd say about a third to greater than a third of our clients are bootstrappers. So we don't
Okay.
have just VC backed. We
Mhm.
actually have a pretty good selection of bootstrap and exciting, some exciting cutting edge and some, bread and butter type stuff.
Yep.
To your question, I would say the biggest change, the biggest difference in the, call it the spirit of the CEO chair
Hmm.
between somebody who's running a venture backed versus somebody who's bootstrapped is the bootstrappers tend to they first of all they did it without outside money, so there's a
Hmm.
pride issue in
Mm.
from an emotional armchair psychologist that I am, that they're hey, I deal with humans and
Oh,
their money on an intimate basis day in and
100%.
day out,
Yes.
right? I get to see
Yeah.
them at their best and their worst, I think.
Mm.
um because there's a pride factor, right? They've already accomplished what the VC-backed CEO hasn't. They have positive cash flow.
Yep.
They have positive cash flow, right?
Hmm.
So having to focus on the runway is not there, right? When you think
Yep.
about the CEO has to focus on their runway and they've got to go out and raise, they know when they need to go out and raise. It's almost like the House of Representatives, right? You're constantly going out to get elected, right? Because their terms are only 2 years long. And
Yeah.
and in these tech spaces, 2 to 3 years is, kind of what you're looking at least in the past has been, in
Yeah.
terms of the time frame, say, to an exit or to a big event, right?
Hmm.
So now that distraction, if you will, of having to worry about your cash runway and raising money, which is what that comes from, is gone. So there's more resource time on the CEO's just practical resource time that they have available to devote to the business.
Yeah.
And like I said, I don't need to go out and raise. Do I need to dilute myself, or should I go out and get some venture debt, which is expensive, but I don't have to give up any equity for it? So maybe on a cost to capital basis, that's actually the smarter move.
Yeah.
You see a lot of traction recently in venture debt for specifically that reason. Yeah, they're charging what I would in the past would be athwart the usurious laws, right? Of usury laws for high interest.
Yep.
It's like, yeah, 30%, 32%. Okay, ouch, but it's not giving up 15% of your stock. Okay.
Correct.
So that has become more of that is a path of liquidity that I see on the bootstrappers. So one, they're not distracted by raising money. Two, they have a different resource available to them typically that the VCs don't tend to touch, which is the venture debt piece, although I'm
Hmm.
seeing that cross over more now. But,
Interesting.
and then the other thing on the bootstrappers is, and I don't want to, maybe it's because most of the bootstrappers we have are Midwest based, but man, are
Mm.
these guys frugal, right?
Yeah.
It's not that they're obsessed with their runway, but they've changed that focus to say, am I really spending my money smart
Hmm.
to get the next dollar of cash? And so, yeah, they're not focused on exit. They're not focused on the cash runway. There's a pride of already having done it. And that puts their mindset at a very different. I don't want to use a term like aura and spook off people who think I'm not a scientist, but there is kind of a, if you will, that's the only word I can come up with, difference between the CEO who's VC backed and the CEO who is not. And that, and so their priorities are different. And so we have to adapt to that. They are different clients. There is for certain a difference in terms of how we deal with them, between the two, how I deal with them at the strategic level for sure.
Yeah.
The other thing too is the bootstrappers, profit planning. What do you do with that profit? What do you do with that extra cash? Do you put it into a retirement plan? Do you find yourself, some sort of, wild insurance or derivative product to invest in? It now becomes more of an investment and tax shielding discussion than it is about a fundraising and evaluations discussion.
Yeah.
I spend easily 80 to 90% of my time with my clients dealing with cash. Whether it's the bootstrappers or the VC backed, it doesn't matter. It's all in the end about what one of my professors said once, which was stuck with me, which actually got me on the path of doing what I'm doing, is you can't spend net income. You can only spend cash.
True. Yep.
Right. So in other words,
No,
don't focus too much on the book income. Yeah, it's important. We need that for comparability, but go back to my evangelical position. In this day and age, it's cash runway and sales growth. Those are the two metrics you should care most about until you're substantial in the ARR and are looking now at scaling issues. And then the focus, the discussion changes to how do you scale it?
Yeah. No, and that makes perfect sense because in the teams that I talk with, it tends to be a bit of both. So some have received venture-backed or angel-backed funding. Some of them are strictly bootstrapped. Some of them have taken on a little bit of cash. Maybe it's through some accelerator, or there's been some small amount, but it's not, if you will, meaningful on the cap table. It hasn't, changed the ownership structure fundamentally or anything like that. I just find as long as you know which game you're playing and you're very consistent about what it is you wish to do, even if it is just continue to grow and be CEO of a company for the next 15 years, or whether it is starting with the exit in mind and moving backwards from there and timing and moving from there. That's that standpoint. I just find people just, when they're in a confused state, that's to me where there's, at least at a strategic level, there's some trouble and mismatch and misalignment of what is it that we're actually trying to accomplish. And I just think from a vision standpoint, it just makes it tougher. And to your point, it is very much about cash, sales, and achievable growth, depending on which bucket you want to place yourself in is something that I see a lot of anyway in the work that I do. So yeah, I guess as a kind of a bit of a follow on to this, do you think, because you've talked about this before, what do you think tech CEOs misunderstand about either annual recurring revenue, ARR, or net recurring revenue, NRR, versus one time from a financial operations perspective and also from a valuation perspective?
Okay, so they are two different numbers, right?
Yep.
And at the fundamental level, the reason why they're both important to investors is the first one obviously is what is going to drive your primary valuation multiple. But the second one is really key because that tells them how sticky your product is. Right? We all want sticky products. We all want the Hotel California you can check out anytime you like, you can never leave type of software, right? It's one of those situations. And that NRR is the single most important metric to indicating, A, that you have a sticky product and that you can land and expand with it, right? You kind of get two reads there. Yeah. And that's that's how I look at it. And that's how pretty much anybody I've had a conversation with on the investment side also looks at that, which is, the ARR is like, that's the size of the car, if you will. The NRR is how fuel efficient it is. I come from Michigan, so you're going to get a lot of automotive aphorisms from me. Yeah. And I worked for a Japanese manufacturing company at one point in the dark ages. But
yeah, no, and that I think is just powerful. From my perspective, there's a lot of, I've read and talked to quite a number of people who've either received a valuation, from PE or from somebody else, and the way they parse out or think about or will pay X, times X for ARR versus, one time we'll call it non-recurring engineering work, we'll call it customized work. It's just, I think teams just don't always think about that in meaningful ways so that, they can genuinely account for, yes, this dollar received is in fact ARR. Here's the substantive evidence for it. This is the small portion, but then work with it or find that their valuation is half of what they think it is or could be, depending on what they, again, how they have positioned what it is they actually do, and then be able to substantiate that. And I know that there have been some ugly people I've talked to have had some ugly surprises and then just felt as though all of their work was, again, because they have that pride, it just ends up being a much more painful conversation than it might otherwise be with what is then perceived a lot of work after that to reshape what ARR means or NRR means versus one time. So, yeah.
I agree. We've had this happen recently, as a matter of fact, with portfolio companies where we come in and it's presented as the ARR is, I'll just throw a number out there, 5 million, right?
Yep.
Well, it turns out that half of that's actually one-off type of stuff that was thought that it was recurring, but it's like, oh yeah, they'll keep doing that, right? There's a difference between a prepayment of a subscription, the gold standard. You give me the full year upfront in full. I now have deferred revenue and ARR counts, right?
Yep.
To these are ongoing fees that are happening on a monthly basis, and they're recurring. Well, they may be recurring, but they're not software, right? Recurring services revenue is valued differently than recurring. We're in agreement there, right?
Yep.
But being able to differentiate and not fool yourself, frankly, into saying something is X when in fact it's Y, that is definitely a pitfall. That's definitely where having, say, a CFO in the room telling you that, this is really not. I mean, one of the things I really enjoyed was, at one of those unicorns, where people would come up and say, okay, we're thinking of doing this product. Does that qualify as SaaS? And being able to opine on it and say, no, not that. But if you did it this way, you could get it to count as ARR. So it's not just telling them, no, that's not SaaS, that's services. And so that doesn't count towards your valuation. To here's how you could build that into recurring revenue so that it does become. To me, that judo flip is really important role for the CFO to play. To say, okay, but you could do it this way. I had a boss of mine tell me once another one of those pithy lines, right? Don't bring me a problem unless you bring me at least one idea to solve it.
Yeah.
That was great advice. I learned from that. First of all, the first time I brought him a problem and he said that, so what's your solution? I'm like, I'll get back to you. Right. And I never, ever took him a problem again without having at least one or two playing cards with me to say, okay, here's how we could do it. That was hugely useful advice at a young age for me, because it's since informed a lot of how I approach my clients. Is like, okay, you can't do it that way, but you could maybe look at this. And so I think that's a really important conversation to have early on with all of our clients is, okay, you're calling it ARR. The other thing is in a measurement, right? It's not just classification, it's measuring that ARR. There are definitely do's and don'ts. Another case in point, came into a client. They said, our ARR is, I'll give you a number, is 4 million. I said, okay, really? And he's doing it on a spreadsheet. That's red flag number one. Okay. Just the CEO doing it on a spreadsheet, just every alarm bell should go off in every CFO's mind at that point. We need to take a look at this. Now, they had at that point, this is an operational, we're getting a little bit into the rabbit hole, but they had stopped their, what it was called at that time, SaaS Optics. It's now called Maxio, which is an ARR tracking ASC 606. It's a really powerful package, which was great that they had gotten it, but they hadn't completed it. They got frustrated. And another reason why they're, talking to me is like, okay, can you get this up and running? I said, yeah, give me about 2 weeks. And I did. And because I know it will calculate ARR Absolutely correctly. There's no, mistake about it.
Yeah.
And I went back to the CEO and I said, that $4 million number you've been telling your board and investors, it's actually 2.8. And he's like, no, it's not. No, it's not. He said to me, you're wrong. I said, okay, this is where judo comes in. I understand can we take a look at your spreadsheet and compare it to what Maxio is showing so we can see it? We were into the third client before he admitted he was completely screwed it up. Right. So it's not just classification between services and software. It's then once you have that software, making sure you're calculating that correctly is another. And it's not rocket science. It really isn't. I know a lot of people want to make it out to be that way, but usually it's about a 5 or 10 minute discussion with a CEO to say, okay, here's what that concept is, and maybe draw a couple of diagrams, and then it sticks, right? And what it really simply comes down to is the annual rate of all the contracts that are in flight right now. It's a point in time thing. And that's the other thing is ARR is not an accounting number. It's a finance number. And people are like, oh, what do you mean accounting and finance are different? Yes, they are. Very much. They're very different. One looks backwards. The other one looks forward. Right. Finance is forwards, by the way. Accounting is backwards looking. It's measuring what has happened. And that has rules about that measurement. ARR is a forward-looking number. It's a leading indicator, right? It's your current run rate. It's not revenue. And that's another conversation I get into a lot. Well, that's my revenue. No, revenue is an accounting term. And there are rules around that. And that's why 12 times your revenue doesn't equal your ARR. Because that's usually where it starts. They'll say, oh, I've got monthly revenue of X. I just multiply that times 12 to get my ARR. It's like, not quite. Not quite.
Yeah.
So
no, I understood. Yeah. There was a piece I was seeing as, come across LinkedIn providing advice for new founders to go ahead and inform their, VC folks of what's going on. Here's what we're doing. Here's our monthly ARR. Here's this. Here's what's going well. Here's not. Here's the ask. And it was, absolutely just times 12, extrapolating out of that, keeping it simple. I think it's a very understandable and easy mistake to make, but usually made too late. As you pointed out, 4 million to 2.5 or 6 or thereabouts is quite an adjustment and not an easy thing to talk with your board about when they're staring you straight in the face. And now you have concrete numbers, which is great, but not when you've changed it in that particular manner. It's just that's like a difficult conversation to have.
Yeah, it hurts the CEO's credibility in a way that very few things can.
Yeah, and it's tough to get that back, and it leads kind of on to my next question here, which I'm sure is a huge value add for you guys as well, which is that how do you guys at SaaS Gurus like to help SaaS CEOs price their contracts and services? I've had personally many conversations when I've asked, and they've said, well, we surveyed our competitors. They had 3 products. We did the same sort of thing. We either upsold at 5%, we downsold at 5% to build market share, do something like that. It was the simplest thing for us to do. And we just simply moved forward with that so that we could hit some basic targets so we could get more money, do something else, or i.e. just not try to look foolish and demonstrate some competence in our area. So I'm curious how you guys go about helping teams or helping CEOs think about their contract and service pricing.
So do you read science fiction?
I do a little bit, not a huge amount, but some.
Okay. So there was this author way back when. His name was Frederick Pohl. Great author. Mm-hmm. Another one of those gave me one of the best pieces of advice I ever got in business. The answer to your question first is whatever the market will bear. Okay. Yep. Bluntly. Now, how do you figure out what the market will bear? Part of it's negotiation, which is, when you're sitting down across from somebody with a product that you haven't sold before and you're trying to figure out the price and you're going in cold, you really want them to tell you what they're willing to pay first before you tell them what your sales price is. Because let's say they have a budget for $250,000 and you were thinking of going in with 25, right? Well, you might want to up that a little bit, knowing that they've got a $250K budget. So that's art number one, which is whatever the market will bear. And if you have to go in cold, try and make them make the first play in terms of the price. Now, let's say you've got some time to figure this out. And pithy science fiction writers aside, okay, that's great, Anthony. Sounds great. Okay, so tell me, how do you really do it? So there's a couple, 3 ways I have them take a look at it. And it's not rocket science. I think too much of my profession wants to treat what we do as, some mystical behind the curtain, don't pay attention to the wizard stuff. And in fact, it's not. First of all, yes, competitive analysis. Absolutely. Take a look at what your competitors are, pretend to be a buyer. I don't care how you do it. Hire a firm, but figure out what their pricing is for what they do. Now, it could be that what you do is not exactly the same, or it's sort of related. So that may be at best kind of a benchmark that may be helpful, maybe not, right? So there's another way you can look at it, which is, why do we have software in the first place? We have software for 2 main reasons. It's to basically make things go faster without human intervention, bluntly, right? It's software is not wetware. Another science fiction guy, his last name was Gibson, came up with the cyberpunk novels. His term for human beings was wetware. It's like, that's a great term. So your software is replacing wetware, which means it's reducing labor cost. And it's also making turning data into information. Data is just the raw bits and bytes. Fields information is the analysis, is the digestion of it, and turning it into actionable, numbers, right? So what is it who on your client's team are you replacing, right? If you're replacing 3 people that run on average $150,000 a year base salary, plus add 25% for overhead, so call it $500K a year combined, $400 to $500K. That's what you're saving them on hard labor costs. That also is a really powerful number for you going into a negotiation to know. You say, hey, I will sell you 1/10 of that. So I have a $500,000, $50,000 ACV, $50,000 ARR contract, because I'm going to save you $500,000 a year.
Okay.
If I'm a CFO and you're telling me that, and I believe your numbers, you've got my attention. You're telling me you can increase my cash flow by $450K a year, depending on how big I am. If I'm GM, maybe that's just pocket change, but assuming we're talking to somebody where that matters, right? So there's what I call the hard value prop method, which is sit down. I mean, if your product fits the markets, that tells me you already know where it goes. Now, maybe it's revenue enhancement. Maybe it's not cost savings. Maybe it's a combination of both, right? Maybe I know that if you put my software into place, let's say I have software that clearly defines your market spend and what the sale was that's associated with it. So you know where to put more marketing money in. Now I've got an idea. So that's another really valid method. So whatever the market will bear, yes, check your competition. Take a look at what human cost you're saving or revenue you're increasing, or flip to the other side. If it's truly brand new, then you're out there kind of figuring it out. I just hate to say it. There's not a playbook for that one to say, hey, I've invented something that's completely new. FedEx came in and completely overnight, no pun intended, changed the delivery industry, right? Before then, it was snail mail and UPS taking 3 weeks. These guys came and said, I'll get it to you absolutely positively overnight. I can still remember their
I can as well. Yeah, it's one of those things like American Express, never leave home without it. That's just perpetually forever in my
But in this case, they created an entirely new market. How did they come up with their pricing? My guess is they came up with whatever the market will bear as their methodology, right? And went with it. So practical advice, yes. Figure out if you can, maybe if you got somebody who's a friend who's in the industry, you can call and say, hey, what do you guys typically pay for software, right? It could be something as simple as that. What do you pay for software that does this? There are a number of ways to get to that information. I think if you're creative, and especially if you sit down with, say, a marketing specialist or a marketing strategist who's in your industry, that's another big mistake I see a lot of CEOs in the startup space make, is they hire the wrong experts, right?
Yeah.
So hire the right expert here, somebody who's in your space, knows the marketing, knows the go-to-marketing, and how to do a GDM strategy. That is just crucial to this whole discussion, because if without that, you don't really have anything.
Yeah, no, I think very, very sound advice, and a smart move. But sometimes difficult to do. You've got context or you get intros, but are they the optimal one? And it sometimes can be challenging to figure that out while you're, flying, building the plane while it is falling through the sky, as we like to say sometimes. So,
another way to do it, I just thought when you said that, and we can leave the topic, is I had a client who was literally brand new space, augmented reality. An application in augmented reality, had no idea how to price it, knew who their client was, actually had connections with them, but established enough of a rapport with that client where they could say, look, we're not sure how to price this. Can you help us?
mm-hmm.
And actually got a prospect to give, and in return, we'll give you half off the first year, throw something in there to sweeten the deal. They say, looking at what we do, what would you be willing to pay for this? You could try that in a couple of cases, and who knows? I mean, but again, you have to get the right prospect who's willing, that's trustworthy and willing to work with you on that. So there was that, because there was a pre-existing relationship. But that's also a way to kind of figure out, at least barometrically, where your pricing should be. Is it 4 digits, 5 digits, 6 digits? Those big dividers right there can be really crucial early on.
Yeah, no, makes a lot of sense, and I think that that advice there is really smart. Provide that you have someone in the space that, again, there is that know, like, and trust, and there's a clear understanding that there's a lot of value exchange, and everyone understands that. So, yeah, no, definitely smart. Why don't we go ahead and take a short momentary commercial break, and we'll be right back. Purple Finch Group helps technology CEOs innovating at the edge of chaos create operational fitness across their technology stack and team of talent. Achieving significant and measurable scale, selling your story, and finding time to think and plan can feel like a bridge too far. So if you're a CEO whose company has found product market fit, but is struggling, or you're a CEO whose company is looking to accelerate existing momentum, we can help with proven blueprints for optimal scale. Shifting from incremental addition to exponential multiplication can be absolutely achieved with less effort and stress. To get in touch, I can be reached at Scott with 2 T's at purplefinchgroup.com. Now, back to the interview. We are back for the Disciplined Troublemakers podcast with Anthony Nitsos. Anthony, to shift gears a little bit here, around I'll call it a more recent story, which is that a lot of VC-backed SaaS companies have, closed over the last 12 months. They've not been able to receive financing, et cetera. Have you guys found a need to help CEOs close out their activities, secure their financial or other IP and just financial data to protect all the stakeholders? Or have you found that you haven't had to do that with your work and with who's funded and other details, if there is a sense of things? But I'm wondering how you've had to respond with your own SaaS company a bit, if you're with what you're comfortable sharing.
So there's a before SaaS Gurus and an after SaaS Gurus answer to that question. So after SaaS Gurus, the 2020 point, we have actually not had any client fail. We've had,
nice.
And I consider to be an extended period of luck. We're now 4 years into it. We're more than 4 years into it. And we have one on the verge, but they haven't closed yet. Prior to that, I would say because I did I've done fractional work on the CFO and the accounting space for close to 20 years now. as you know, this is the gig I do now compared to the other stuff that I tried and said, now I want to move on to something else. This is the stuff I've been pretty much with because I love working with CEOs. I love just working with people who are that driven or that visionary or that gifted or whatever it is, smart. They're in that category of right. These are great people to have conversations with, even if you weren't working for them, right?
Correct.
So I really enjoy that. So that said, after SaaS Gurus, after we started in January of 2020, remember what else was going on then? That's when COVID started.
Yes, exactly. Yeah. Well, in earnest, it did. It cranked up. Yeah.
Oh yeah. I mean, so anyway, now that said, we've had one, I like to use, either car or plane analogies. This is a plane analogy.
Cool.
Flew the plane this close to the ground of cash without running out and has slowly managed to pull this thing back up. And that was because of pivot in the product, right? So it comes down to, I think, a couple of things. If you're headed towards the ground, there's really a limited set of things that are wrong. Your product market fit's the first thing to take a look at. Does your product actually solve a problem that people are willing to pay for, right? Let's be very blunt about that.
Yep.
After that, the very next thing in line is your go-to-market strategy. How are you going to get actual contracts closed? Okay. And if you don't have solid handles on both of those, you're going to run into trouble. And it has to be both, right? You can't have a great go-to-market strategy for a piece of garbage, and having the world's next best mousetrap without a way to get it to the market is, a waste of everybody's time. It's like, I'm trying to think of an analogy, having a, blinking contest in a black room. I don't know. So there's that. Now, the ones that have come close, in both cases, they were able to flip one of those switches so that they were in alignment. It was either a product market fit. Oh, we're in the wrong market. Good product's good. We just need to move over to this segment, versus how we're getting there. People aren't understanding our message because we need to change this is the message that resonates. It could be that simple, right? So it's a positioning switch. People tend to think of the CFO as the numbers person. No, we are the entire organization person, which means we have to understand what's going wrong with sales. Right? Back to those two metrics, ARR, sales growth, and cash runway. Those two are two sides of the same coin. And if you think you're an expert on cash and you're not also at least a really good armchair expert on the sales side of things, then you're not going to be as effective as you can be for your clients. Bluntly.
Amen to that. Yes. Yeah. No, I think there is this overwhelming perspective that the CFO of the value a CFO provides, but again, is sometimes not as well connected to the sales side of the house. And then if you want to take it even a deeper step into marketing a bit as well, and then obviously because of it being SaaS, just the technology piece and what that is, that you really are just kind of putting a finger or a set of them on the pulse of the entire organization, not necessarily for control, but to really have awareness and to really be looking, to borrow a plane, or I'm a motorbike fan, you're flying 12 seconds ahead of where you actually are or more. And to be able to see that's hugely important. Yeah. And I think often missed. Yeah.
There's two things going on. One, we're typecast. CFO, we're the finance, right?
Yep.
And the other is many of my compatriots come from accounting and finance backgrounds. I don't.
Yep.
Right. I look upon the corporation as I look upon, you mentioned, yes, I was in medical school at one point and decided not to be. Corporations are human bodies. Cash is blood. That's a really easy thing for me to get my head around and treat the patients accordingly.
Yep. In a previous podcast, you've often talked about the skeletal system and other ways to basically create a healthy body. There's a healthy company, and everything kind of lays off of or hangs off of other things with that lifeblood, flowing through what should be a healthy set of arteries, veins, etc. And when there's something suboptimal, let alone below optimal, it's hugely painful and destructive.
Yeah, the analogies between the human body and our companies is, I can go on and on. The parallels are really profound and extensive. We really have built our corporations in many ways as an extension of ourselves, as both humans, individuals, and both humans collective, right?
Yeah.
So it's, for me, I look upon, that's why I look at it and say, tell me, is there a single decision in your organization that doesn't ultimately have a financial impact? And the answer is no. There isn't a single decision in the organization that doesn't at some point show up in the profit and loss or the cash flow. So the further up into the chain that you understand where those decisions originate that can impact the P&L and the cash flow, the better you are as anybody in the organization at the C-suite level. Frankly, I don't think it applies just to the CFO or the CEO. The CTO, same thing. Don't be somebody who just is focused on the product. You got to understand that your product is there to be sold and that you're there to build valuation for your shareholders. That's kind of part and parcel of the whole thing. It's don't be an unintentional not-for-profit. Right?
Yeah, no, it is true. I just think sometimes we all, and I'm guilty of this myself, you get into the weeds so much that you miss the forest, and you just get bogged down in technical details, whatever that, in air quotes, technical topic happens to be, finance, technology, whatever, and then just lose sight of or get pushed into one forest fire after another, and it's tough to, again, always keep pulling your nose up and being able to either fly the plane, ride the motorbike. There's a car analogy there as well, for essentially being able to move forward and keep everybody lined up and doing meaningful things and not becoming that nonprofit, as you say, instead of remaining exactly where you are as a for-profit entity, and really just firing on all cylinders, however many cylinders you happen to have. Yeah, no, very, very true. What is it? Because you're a SaaS founder yourself. What have you found to be the most enjoyable part of the journey founding SaaS Gurus and then working with technology companies, working with CEOs?
The two things are, one, I mentioned earlier, getting to work with people, getting up every day and talking to people who are super smart, super driven, super capable. I mean, you don't become a CEO of a SaaS company as an afterthought, or as I tell some of my clients, I say, you have to have a certain type of crazy to do this. Okay. This is high risk stuff, but working with people like that who are bringing to market technologies that are mind blowing, I would say easily within the last year, half of our client base has turned into AI clients. Right.
Yep.
And AI is, everybody talks about AI. I'm living on the front line of AI in terms of, oh, your product does that? And it's like, wow. So there's that cool factor of the cool people and the cool technology. The other thing that, really I think drives it for me is that I'm helping them outsmart their competition. I'm helping them figure out how to bring jobs to people so they can go home and pay their mortgages and have their kids go to good schools and, do fun things on spring break. It's, we live in a world of money, and money enables a lot of stuff. It prevents a lot of stuff, enables a lot of stuff, right? It's a two-edged sword like everything. But in the end, these are businesses employing people who got to get up in the morning and pay their bills and buy their food and take care of their families or not, however it happens to be. And so knowing that what we do has a direct impact on companies' success in that area, that kind of feeds the doctor in me that never left medical school. The one who wants to heal people. That part of me never went away. There were many reasons why I left medical school, but it wasn't because I didn't want to take care of people. And so I take care of companies as people now, and of course they're made up of people. So I think that's where it really is for me.
Yeah, and that's really cool. For me, it's just the energy a lot of tech founders bring to the table, which you mentioned too. AI is one of my areas of interest and whatnot. And just what people are doing and how they're doing it, how they're thinking about it, and building a vision and aligning people and resources around it. It's just super interesting. It's just a really, I think, cool place to be, and will continue even when the things die down a little bit, I think it will be a very interesting and dynamic place to watch teams build themselves, to watch obviously the technology. But for me, I think it's still very much a human endeavor, not to go down a rabbit hole there, but I think it's hugely exciting. So what does, for you guys, what does SaaS Gurus what does scale look like for SaaS Gurus here in 2024? Is it same as what you guys have been doing, or are there other things on the table, at least with what you're open to sharing?
My company itself, or for my clients?
For the company yourself, yes. Yeah.
Of scale for us. So up until this point, we've had a lot of success with word of mouth, right? Start small, but I've always come at the perspective. This is where the Japanese, working for the Japanese really kind of brought this to the forefront. You're not there to meet your customers' expectations. You're always trying to exceed them. Mm-hmm. Do you remember a TV program called MASH? Did you ever see that?
Oh, no, most definitely. Yes.
Okay. Remember Radar? Radar would always be there with the answer before Colonel asked the question.
Correct. Yep. True.
I want to be and hire radars, right? I want us to know before our client asks the question what the question is going to be and have the answer. I think that's what clients hire us to do. Is we're not there to figure out with them. We're there to come in and say, here's how you do it. Okay. Mm-hmm. And so for me, it's that, that evangelism that comes from word of mouth. So we've been, pat myself on the back. We've been successful, right? Mm-hmm. I really don't just say that. We live it. We do try very hard to anticipate our clients and exceed their expectations. And then they tell others about us. And so we've been growing greatly. I think at this point, the scale for me now is we have accumulated as a team a lot of experience in the area of SaaS, not just SaaS finance, but SaaS HR, SaaS benefits, SaaS insurance. I mean, I said there's nothing in the organization that doesn't have a financial impact. Yeah. And so we're more of becoming a one-stop shop SaaS function, if you will. Strategic enabler is the way I like to look at it as an organization. Well, that requires a different series of processes. It requires our own use of AI internally, and how do we use it to leverage our time. And so I think scale for us is how do we get to be more evangelical about what we've learned, right? If a guru is the person that you go to on the figurative mountain to get wisdom from, what mountain do we get on top of, and with what megaphones, so that we can broadcast to the world, hey, this is accessible way for you to do what you're doing. Make it easier. We don't guarantee success. You have to have the right product market fit, et cetera, et cetera. But if you really need somebody to help, maybe it's not us, but here's what you should be doing. Here's how you should be thinking of it. Yeah. That's where scale is. So thank you for inviting me onto your podcast very much. Getting in front of groups of people who are interested in what we have to say is part of that. And basically going through the process of how do we go from pretty much a word of mouth strategy to a true outbound. What's our go-to-market strategy? We're pretty clear on what our product market fit is. What's our go-to-market strategy? And our go-to-market strategy is stage 2, which is what we're in right now, which is we think we have a great amount of content and we've got some really good stuff for people to take a look at. How do we now get the word out so that people, when they have the conversation about SaaS or SaaS finance, the name SaaS Gurus comes to mind because you heard something, you heard me say something that resonated. You heard us out there talking about, best practices, not from some theoretical standpoint, but, how do I treat the patient? How do I actually correct that, get that symptom to go away? That's what our approach is. And we are not primarily numbers people. We're strategic enablers. We use numbers like a surgeon uses a scalpel.
Yeah, no, I think, for me on a personal level, I tend to, when people ask me what I do, there's the practical answer. But I my answer is typically around not just strategy, but around the thinking of the organization, which I think is the most powerful lever that there is. and that, it divides itself between the finance piece and, if you will, as kind of almost a psychology piece, where we are very much focused, or I am, around the human endeavor within the technology space, and just how much leverage there really is that is not always optimized in ways and strengthened and nourished in ways that it could be. And I just think the power of it, there's still a lot to take advantage of or to move forward with and really help people out. So we're in 100% agreement there as well. Yeah. As we go ahead and wrap up here, how would you like people to reach out to you? Do you prefer LinkedIn, or what would be the optimal way for reaching out to you once a CEO or somebody in a leadership position listens to the podcast?
I'd love it if people would just go to saasgurus.io, so SAAS Gurus, GURUS.io /lab. The lab is where we put our ebook. It's where we have all the information, podcasts, content, whatnot. We've worked really hard to make it easily accessible, for you to find what you're looking for. And if you're, you want to reach out to us, we'll get that information. But I download the ebook from the lab. It pretty much covers what this interview has covered in many ways. It's kind of the approach, and how does this work, and what are some best practices, and what are some practical things for you could do right now today without having to hire an expensive consultant or, go outside. Because a lot of it is, I think, where I see it, to answer your question about scale, if you go to saasgurus.io /lab, is that's it. We're presenting this information in a way that makes it easy for people to access and use in their companies today. Because we want to share it. It makes it, all the boats get lifted with the tide, right?
Indeed.
And then within that, if you give us your email and whatnot, it's going to show up in my inbox, and my marketing person is going to make me do something with it.
That is fair enough.
That's her job.
So,
that's my CMO's job.
So that's our for the audience, those listening and those watching when this goes up on YouTube. That's your gentle call to action. And thank you very much. So I guess one of the final question I always like to ask a guest is, is there maybe one or two things that you and or SaaS Gurus would like assistance with over the next 12 months? Is there something that you could use help with or guidance? Again, once somebody listens to this and thinks, I could actually maybe help Anthony with that, or at least point him in the right direction.
It's really simple. If you know a CEO or a founder of a SaaS company who's in some sort of pain that we were talking about today, just have them reach out to me. Okay. I'll always love to talk to people and find out what's going on and whether I can help. We can't help everybody, but I'm always open to the conversation to find out if we can, because again, I go back to, I do this because I care about the fact that this is a real world thing. This is people. This is businesses. And, what are we going to do with ourselves if we're not employed?
Yeah.
We sit around and pick fights with each other or whatever it is. So
we have to make stuff up. Yeah.
We can have a whole episode on how I think economy came around in the first place, because monkeys needed something to do with themselves.
Sounds like a good book title. So,
Right.
Sounds good. Well, Anthony, as we close out, thank you very much for carving out some time to chat with us today on Disciplined Troublemakers. I really appreciate it. At some point in the future, we'll have to have you back on the show to talk about some of these topics in more detail. And for all of you out there who are either going to be seeing this podcast or listening to it, thank you for tuning in. We'll have a new podcast as well out very soon. Thank you, and until next time. Thank you for tuning into the Disciplined Troublemakers podcast, and we hope you found the episode valuable. If you did, please subscribe to the Disciplined Troublemakers podcast on your favorite platform and leave a review. Putting this podcast together is a group effort, so I'd like to provide a shout out to Heartcast Media and their team for all of the assistance they provide with each episode. If you want to get in touch with me directly, I can be reached at Scott with 2 T's at purplefinchgroup.com. Purple Finch Group is the sponsor of this podcast. We have another podcast episode out very shortly. Stay tuned.